Hi, you're listening to Avenue Insights. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based on information available at the time and are subject to change without notice.
Welcome to the Q4 2024 podcast, or the summary of the quarterly letter. And just where we're sitting here today, it took a few weeks to get organized, get the report out, and then we're finally have a quiet afternoon today. It's just very interesting. We're sitting here on a Tuesday after the tariffs were introduced on the weekend, so we might as well just go real time. A lot of what we talked about in the quarterly letter was what was going to happen with tariffs, but just in terms of real impact yesterday. And when we went back through the portfolio, 2 months ago, saying what was going to be the impact, I'll just give you the quick update, is that we really felt that the actual portfolio of public companies that we own, that the businesses are sort of very independent of a cross-border trade tariff. And what we found was that the portfolio was down 0.5% yesterday. And so there was a fear, and there was sort of the stock market opened with a bit of a panic in terms of a number of stocks, and it really was a non-issue by the end of the day. Now, it ended up, the tariffs were rescinded, it looked like, for the next month. But in terms of what the actual impact is on public companies, it doesn't seem to be as much as what you will actually have at the consumer level, like the grocery level. That's where the impact of tariffs will be. It won't necessarily be a public company earnings level at this point. Is there anything else you saw yesterday?
No, I think it was just one of those days that it happens every once in a while. And I think, and I was saying to you just before we started, but there was we got the morning calls from two publications in Canada, asking, could we provide comments on, how we're changing our investment strategy because of the tariff news over the weekend. And our response was that, we're not changing what we own because of this. This is something that was well telegraphed, and we really like the high quality companies that we own, and we're not going to change our portfolio because of a one-day move in the news. Then at the end of the day, we got the same people called us back for comments again and saying, can you give me your comments on how you're going to change your investment strategy because of the rescinding of the tariffs? And so that was kind of the absurdity at which the financial news cycle operated yesterday. And again, the comment is, and what you just said is that, we own, or our objective is to always own high quality companies because we think those are the better things to own. And tariffs, whether they're on or off or come back, we don't believe that our overall businesses are necessarily harmed by tariffs in a way that other companies might be. And so it's important to sort of be able to look through, news days like yesterday and just sort of zoom ahead. And I think if in any way we're going to replay the 2016 to 2020 news cycle, there's going to be a lot of days that are going to be like this. And I think investors have to just stick to what they're doing and their plan is, because there's going to be a lot of whipsaw and a lot of headlines. And this is what happened the last time. And I would expect this is probably not something that's going to change.
And when they actually noticed a few stocks that actually moved about 3-4 weeks ago, when they've started actually coming off and sort of saying, will this resource business actually be affected by tariffs? And the stock market sort of discounted that a few weeks ago. And then you can even say, right, where the currency is right now. Currency has a lot to do with the different, the Canadian interest rate being much lower than the U.S. interest rate, the U.S. budget deficit, and the strength of the U.S. economy. But then tariffs certainly don't help either.
Yeah.
And so a lot of this is just already in the number.
Yeah.
Okay,
yeah.
So let's go right into the report. You started out with a great picture, which is a fun one, of the duck rabbit. And I just want to ask you, why'd you pick that, and why do you think that's relevant? I thought it was great, but what you was relevant, but where did you come up with that idea?
Yeah, so we won't try to pronounce it in German, but essentially it's a picture from a magazine, late 1890s Munich, and it's an image of both a duck and a rabbit together. And essentially it plays with the human mind in that you can look at the picture and see both. So you can look at the image and in one vein see a duck. At the same time, if you sort of shift your perception, you can see a rabbit looking the other way. And there are other pictures that have the same sort of visual effect that I'm sure people would be familiar with in some way. But I think this picture and the premise is a great frame to think about, how to assess both the economy and the stock market. And then we kind of introduced the letter talking about sort of the political changes that have happened in the last couple of months. And I think there's, in many ways, we live in a very sort of emotional political age, and there's, everyone has their own individual emotional reaction to, whenever there's a political change. But I think from an investing perspective, it's important to sort of always take a step back and sort of pan the landscape and be able to understand things from different perspectives. That's kind of essentially a huge part of investing. And I think this picture frames it, because I think the initial reaction from a lot of the press, both in the US and Canada, was sort of this, again, surprise at the fact that Donald Trump won, and this, how could this happen again? And it was from all intents and purposes, the polling was suggesting it was going to be really close, and he sort of ran table on all of the swing states. I think the number we use in here, this number is he had 14 million more votes from the first election, which any second term president has actually never done. So even when Ronald Reagan won again, he had less votes. When Obama won again, he had less votes. So it's just to assess the picture in the US is there's a lot of people who like Donald Trump, and sort of what we get into then is trying to understand why that is and sort of highlight it through the inflation perspective, which maybe do you want to...
Well, yeah. Well, okay, so this is where it sort of comes originally off as being a political piece of sort of saying this is, we're voting for a more business-friendly environment. But technically, you've got one great slide in there because we're sort of going through where did this, what really shaped this outcome. And you've got a great chart saying actually there's one figure on inflation that really moved it. And again, looking at whether it's a duck or a rabbit, you can say it's all, or how the media might paint it one way, or common wisdom might look at the answer, but it's really a bit of a protest vote, sort of inflation in this incredible stat.
Yeah, so there was an image, and we'll try to put this up on the YouTube video of the podcast, but it's from the Financial Times, and when I saw it, it grabbed my attention right away because it's it is intuitively in line with a lot of the other stats and data about how people feel about the economy. But it's essentially, it took the electorate and broke it down between essentially class lines. And it was people that were harmed by inflation. The next category was people that had a moderate harm from inflation. And then the next category was people that were not impacted by inflation. And if you look at the top part of the chart, people who were harmed by inflation on this survey voted for Donald Trump with a 7-1 margin. And there's a lot of people in the US that are in that category. And so that image to me, I guess, represents, how I would view this election. And again, it's sort of an election very similar to 2016. And there's a large majority of the US where there's this sort of economic discontent, and standard of living for many Americans is not high or growing. And so, a lot of the vote for Biden was, again, a protest vote against Trump last time. There's a lot of this election that is just a protest vote against Biden, but it's really not necessarily against Joe Biden and Kamala Harris. It's really the inflation and the hit to people's living standards that inflation causes. And that graphic bears that out pretty strongly. And I think, again, we've now gone through this cycle the last couple of months where there's this, now popular, or there is a high popularity that Donald Trump has right now. If I could bet on anything, I would say that that's not going to last. And I would say that if we look back in 4 years from now, in the next election, there's highly likely to be, a similar feeling about, and votes going the other way again. Because again, as we've talked about, ad nauseum, the structural challenges of the economy and debt levels and all these things are very high, and no politician can solve these. But again, it's just framing it to help us understand and look at, say, why do we think people voted for Donald Trump? And that's really, a key reason that I think is often overlooked, because it's the emotional reaction that people have. But from people's own voting belief, like they think they're making the right decision to vote for Donald Trump because of these reasons. And so I think if we're going to have analysis about the election, we all should try to go into the head of those voters and try to understand it rather than
And it's
just
not, I would say,
discard it.
at least the way you've written it, is that this isn't a vote for Donald Trump, it's a vote against inflation.
Yes.
And then when we now start going to the other pieces where we start talking about a trade war and tariffs and where we are in the stock market, I think what's interesting, which is great about still using the rabbit and the duck picture, is that how you think you're going to solve this might not solve the inflation problem. And the world we're going into. So I think you've actually made a great argument. This is now going through the body of it, of saying, again, first one, having a trade war, and I would frame it this way, saying you can't have it both ways. You can't have a reserve economy and you can't have a great manufacturing base at the same time. And you want to just spend a minute on that, what that really means, and what's the situation that the U.S. has got itself trapped in that's really hard to unwind.
Yeah, I think the sort of 20,000 foot view of this is, and what we talk about in the letter, and trying to explain this from there's a very simple way to explain how the global economy is structured, and it's essentially the U.S. is the global hegemon, and they are the reserve currency of the world. So what does that mean? That majority of global trade is conducted in U.S. dollars, and the reserve asset of the world is U.S. treasuries, so the government bonds of the U.S. And if you're the reserve currency, your job is essentially to supply your currency to the world, and in effect, you have to be running a trade deficit against that your trade partners. The problem is, and we kind of get into this in the letter, the system has metastasized in a way that the structural trade imbalances, specifically between the US and China, have grown so extreme that it's now creating these knock-on effects back in the US, where manufacturing jobs have left, and the US is largely deindustrialized. And I think COVID was maybe the catalyst and the inability to actually source items from China, where you actually now have a sort of revisiting of, on a policy level in the US, how do we reshore manufacturing? How do we reindustrialize our economy? And it's in many ways that you can't do it under the terms of the way the global economy is structured today, because China, Japan, and Germany, which are the three other biggest economies in the world, they are all export economies with low consumption. They produce things, sell those things to the US. Those economies, they're not able to raise consumption as a percentage of their economy because their economy is set up to export. And so if the US wants to start becoming an export economy, it's like square peg, round hole. And you can't really do it if you're supplying the global reserve currency.
Right, and they're all using the US dollar as the reserve currency.
And then all of these trade surpluses around the world, they end up being recycled back into US assets.
I do want to hit on that, but this is actually, that it always comes up in articles and things, and it's not saying it's a throwaway line, but it's really the impact of this. So one, I think most people can grab the reserve currency, how it's difficult to have manufacturing in the U.S., but this last piece, because it really comes into financial markets, but saying when you have a reserve currency and they have a surplus of savings in China and Germany, what happens? So essentially, and this is a benefit, the U.S. has benefited from the system in many ways, because you're able to consume much cheaper goods, and your financial markets have benefited because the trade surpluses that accrue to your trading partners, that money has to go somewhere, and the only liquid market in the world that's big enough to absorb it is the U.S. financial markets. And so when you see, there's a trade imbalance on one hand, where the U.S. runs large trade deficits, and at the same time, that capital then gets recycled back into U.S. assets. And so the U.S. has benefited from that recycling of all of that surplus back into the U.S., but it goes to benefit financial assets, and it doesn't benefit
working class or manufacturing. And essentially, and to distill it to a sentence or two, the way the global economy is structured right now is that it creates a disproportionate demand for US dollars and US assets. And because the US dollar is then stronger than it otherwise would be, producing any goods or manufacturing in the US is uncompetitive relative to trading partners. And because you have global capital can flow anywhere, money is like water, and capital will flow all over the world where it can seek its return. But the U.S., if you want to redo manufacturing in the U.S., the Band-Aid solution is to do a tariff, but it's not. That's not how.
So
the problem is much
over
bigger.
the head. So tariffs are going to solve everything, and so. But then you wrote a great example. We have had tariffs. We had tariffs the last time Trump, and then what was the result of that? What's it like? You had a great one clear example of saying it's just not as simple as you think when you use tariffs.
Yeah. So the last time, and the example we use in the quarterly letter this time is in 2018 when the U.S. imposed initial tariffs on China. China retaliated by tariffing U.S. exports of agricultural products, so wheat, corn, soy, some other agricultural commodities. So what happens if you're a corn producer in Iowa or Illinois, or you're a soy producer in Nebraska? What do? It's a hit to your income. So you call your senator and say, I don't like tariffs. And then what happens is the U.S. government has to then bail out farmers. And there was a great chart in there. And there's been a lot of research done, and this has been well kind of researched, after the election, after the last presidential term, essentially almost dollar for dollar. So whatever the U.S. raised in tariffs from China, almost dollar for dollar, that was then sent to farmers to make up for their lost income. So there's not, you'll hear, oh, well, we raised all this revenue from tariffs, but on the right hand, but then you had to bail out other parts of your economy on the left hand. So it's essentially, you're redistributing income through tariffs. And especially with you have open flow of capital, tariffs then just get reflected in the currency of the country that is exporting. And so the U.S. is actually, it's not necessarily benefiting if a country retaliates and then they have to bail out another part of their economy. So there's this sort of this growing kind of economic nationalism that a lot of this gets wrapped in, and it's easy to get everyone fired up about it. And, Doug Ford can take all of the California wine out of the LCBO for a day, and like that can happen, and people you can get energetic about it. But again, tariffs are just sort of this surface level discussion or policy. You're trying to solve, it's like you're trying to solve cancer with putting a Band-Aid on your, on your body. That's what a tariff is.
Right. And then I'd also say that from our starting point, once we're, 2016, where we had these conversations, but now we're in 2025 at the beginning of the year. And then you've got a great group of slides of sort of saying this effect of having this circling around and buying of financial assets. And we're really at an incredible extreme. You've got a number of sort of different measures that you put in. And it's in last year was the most amount of money coming into U.S. financial markets ever, by the end of the year. So even though we're starting with this, which is clearly a disruptive policy, from the point where you're actually, the markets that are all-time highs, valuations are all-time highs, and a huge amount of money has come into the U.S. market, where now the U.S. market is disproportionately bigger than any other market on earth. Mm-hmm. And it just keeps, and we've talked numerous times of just about those handful of stocks that it goes into, but it's also really this phenomenon that the money isn't going anywhere else.
Yeah.
It's coming into the U.S. and coming into financial markets.
Yeah, and I think I think what we tried to highlight is just to frame the trade situation and to try to explain it, and like the way or the degree to which trade is unbalanced today it's a major issue. The problem with this is a situation like this cannot continue forever, indefinitely, and there needs to be some kind of sort of global solution that comes from rebalancing global trade. But you can see how it's a very challenging thing to do, because I think most of the parties involved would disagree with what the issues are, or if there are issues. But that's a side note. When you have capital flowing into the US to the degree that it is, what happens is it pushes up asset values. And the other point that we wanted to highlight and just to show, because we're at such an extreme, is that on various metrics of valuation, and the simplest one is market capitalization to GDP, you're at the most expensive valuation ever for US assets. And then the other frame we try to apply is you could have, again, the rabbit and the duck is, on one hand, there's an argument why the US financial markets are the best ever, and it's where the best companies are, and it's what everyone wants to own, it's what everyone owns, and so everyone should just keep doing that. And then on the other hand is saying all of these global capital issues have created the biggest financial bubble ever. And there's a valid argument for either side of that. And but I think there's not.
Well, I'll throw it out. I think you actually posed the exact paradox of saying this could be the golden, or Trump is saying this is going to be the golden age of the American economy. But he's not saying this is going to be we've actually gone through the golden age of the American financial markets. But golden age of American economy might be the unwinding of the financial markets.
Yeah.
In a funny way. And this is, again, looking at the exact same image from two different ways. And how you phrase this is that if more money goes to labor or more money goes to other parts of the economy, and there's not much money sloshing around financial markets, financial assets might take a holiday. And then you actually get the economy does do well, but everybody's head just like, well, the economy does well, the financial markets do well. No, actually, that might not happen.
Yeah, that's the paradox of it is if you working under the assumption that if someone actually wanted to try to rebalance the U.S. economy and make it work for, let's say, the tens of millions of people that voted for Donald Trump, the way to do that actually is inconsistent with having financial markets continue to do what they've done. And it's essentially, if you want to have the strong economy and you want to rebalance trade, it's not going to happen alongside a rising, parabolic stock market. And essentially, the stock market, a large contributor to why U.S. assets have done what they've done and the strength of the U.S. dollar is because of these trade imbalances. And if you want to solve that, you can't solve that without then sort of taking a hit to financial assets. And so I don't think it's not a trade-off I don't think any politician would make openly, but that is sort of the honest trade-off. But the counter argument would be that price is actually too much to bear, and so they aren't actually going to restructure global trade.
Oh, it's, yeah, a lot of uncertainty.
And you're just we're just going to hit the gas pedal, and the financial markets are going to do what they're going to do.
I think you've landed on exactly where we always come out. I love that you wrote this. It was interesting to have this conversation about how many moving parts there are to the economy, financial markets right now. Always just drill it back down to what we're doing, because again, I think that all this uncertainty means that let's just be a little more cautious than normal. Always in terms of when these kind of flexibility, I always worry when you say, okay, we have to be nervous about these things. It's not to stop investing. It's just to be very cognizant of where the markets are so we can take advantage of what opportunities might be coming up. Mm-hmm. So that's, I think, how we always frame it and say we're going to be invested, we're going to be in the market, we're trying to make money in these markets, but how do you make money in a smart way and then take advantage of what we see? So what do you feel and what are we looking at right now?
Yeah, I think, and this is how we wrap up the letter, is that we always, when we try to explain these things or provide our perspective, it's not just for the sake of explaining it. It's always sort of painting the picture in the context of how we see the world, but then bringing it back to how are we investing and why in relation to the environment that we observe or we see. And essentially, and to your point from the beginning, where we looked at this a few months ago, and it's something we look at constantly, is that when you own a group of really high quality companies, and our definition of that is companies that have the characteristic where they can be profitable for long periods of time very consistently, you can be confident owning companies like that regardless of the economic environment. And so again, there's the headlines from this week or the weekend or what will come in a month from now or 2 months from now are not going to knock us off of that focus on always trying to find what we think are the most consistent and quality businesses. And I think that's an environment where there's lots of companies that are doing really great right now. And there's a lot of businesses that we own where we think the reinvestment potential in the business is excellent. And there's lots of things that we own where we think the dividends are really stable and very consistent based on our view of profit. So there's always a way to be investing in things to be doing. And also there's things to be avoiding. And so to your point, just a minute ago, it is an environment that we think deserves some caution. Doesn't mean we're not investing, and we've got a lot of businesses that have done well in terms of appreciation, and so we're very happy to be owning what we own here. But I think that the uncertainty, is just beginning, and we're 2 weeks into the administration. I mean, this is going to be 4 years, and so I think for investors, it's very important to just focus on sticking to your plan, sticking to the philosophy around how your money's being managed, and understanding what you own and why. And you have to, in some degree, sort of tune out the noise, because there's going to be a lot. And I think that in terms of noise, this is really just the beginning, and it's going to be a long 4 years if investors get too focused on the week-to-week news cycle, because there's going to be a lot of stuff that happens.
I think that's great.
I hope you enjoyed today's conversation. You can find us on avenueinvestment.com, where you can learn more about the topics discussed today at our blog, or subscribe for updates to our content. You can also follow us on YouTube, Apple, Spotify, or wherever you get your podcasts. Thanks for listening, and we'll see you in the next episode.